Can we stop it and I'll start? Yeah. Ladies and gentlemen, welcome. Good morning, good afternoon, and good evening to you all, as yet again we have registrations from all over the world, some 36 countries at the last count. Thank you for your attendance. For those of you who don't know me, my name is Robin Dand, and I am the Secretary General to the Federation of Cocoa Commerce, otherwise known as the FCC. And as before, I am your host for this session. I'm addressing you from the heart of the City of London and welcome you all to this, the second FCC webinar, which is entitled Price Risk Management in Cocoa Trading. Again, for those of you who are unaware, the FCC primarily exists to publish sales contract terms for the international trade of cocoa beans and cocoa products, and to provide contracting parties an arbitration service in the event of a dispute. However, we are also involved in education in cocoa through courses, online modules, and of course, webinars. I am delighted to inform you that the format today is that we shall have two presentations, each of around 20 minutes, to be followed by a panel discussion that will be moderated by a previous chairman of the FCC and who is also the current vice chairman of the European Cocoa Association, Paul Davis, who is head of cocoa at Sucden, based in Paris. As a reminder, we shall finish at 1:30 London time. So before I introduce our two presenters, I would just like to make it clear to you all that this webinar and others hosted by the FCC are done so under the Chatham House rule. And for those that need reminding, the rule states, when a meeting or part thereof is held under the Chatham House rule, participants are free to use the information received, but neither the identity nor the affiliation of the speakers, nor that of any other participant may be revealed. Now, the purpose of this rule is to help promote discussion, not to stop it. So you are free to use the information gained, but if you wish to attribute it to a person in any onward publication, then please ensure that you have the permission of the person who said it. Now I shall introduce our two presenters. The first of whom is Job Luning, who is Global Director of Cocoa Sourcing at Cargill BV in the Netherlands. Job is a very able and valued member of the FCC Council, and we're grateful that he has taken a lead and will provide us with an overview of the management of price risk in the world of cocoa. His presentation will be followed by that of Jason Estrada, commodity trading consultant at Evertree, who I'm also very happy has agreed to be with us today. And the reason for my delight is that apart from anything else, Jason is joining us from Ecuador, where he is based. So we have a valued presenter on price risk management located in a country more renowned for production of cocoa. This will allow us to explore with a degree of expertise the issues of price risk management common to exporters and providing us with a global perspective on the subject faced by FCC members. Following Jason's presentation, Paul will introduce the panel to you, which includes not only the two presenters, but also Pamela Thornton, an independent trader and analyst with more than 30 years experience of cocoa and coffee markets, and Antoine Delsart of Touton SA, based in Bordeaux, both of whom are experienced in this field of interest And naturally, I am also very grateful for their contribution. So now, without further ado, I shall entrust you all to the very capable hands of Job. So Job, please feel free to start your presentation.
Okay. Good morning, good afternoon, and good evening to all of you. Thanks for joining. Let me see if this works. All right, I think I am now sharing my screen. I hope you can all see it. Robin, please, please let me know if it cannot be seen, else I will start.
It's looking good, Job.
All right, excellent. Thank you so much. Indeed, my name is Job Leuning. I'm the Global Head of Cocoa Sourcing at Cargill, and I'm very happy that you're all joining for this seminar on price risk management. Let me first mention the agenda for these 20 minutes. I'll quickly go into what is risk and what is risk management. Then we'll cover shortly on hedging of cocoa beans. I'll explain a bit more on differentials, and I will explain a bit on cocoa products. Now, risk management. So the first question is, what is risk? Now, we are all active in the cocoa sector or in the chocolate sector, and risk is exposure to uncertainty that may lead to significant losses or gains. So we all have our business and we think that we have an ongoing business, but there is always uncertainties that may come around that will impact your business. Now, how do we manage those risks, right? So it's very important to identify the risks, to assess the potential impact on your business, and then to prioritize which risks you will monitor and which risks you will try to minimize, and which how you control them. So as risks may lead to losses and gains, that monitoring and applying resources is very important for the success of your business. Now, there are many risks in cocoa. So here we have the jigsaw puzzle of risk. As you can see, many risks may impact whatever activity that you are doing in the cocoa value chain, right? You can see there in the middle that, for instance, freight and logistics is a very actual one due to the astronomously high freight prices that the world is facing today, right? So that is an uncertainty that may impact your business wherever you are in the cocoa value chain. Now, in the end, it is the consumers that eat our chocolate, right? And many consumers are unaware of all the risks that are present in that value chain. And I just wanted, before we go into price risk, I wanted to give you a very brief overview of one of the risks that many consumers are unaware of, right? That is the infrastructure and the accessing of cocoa in cocoa value chain, right? That just reminds us that being in cocoa is a risky business, right? And this is just one. Now, this presentation and this whole webinar is about price risk. Now, what I have done on this slide is that I have a very brief overview of the various players in the cocoa supply chain. Now, this is a very limited version, but it gives a bit of an overview of how cocoa moves along the value chain. What you see here is that there's the farmer at the beginning who's exposed to price. Now, the farmer typically would prefer to have a stable, high price for cocoa, whereas the consumer at the end typically prefers a low price for the chocolate that it's eating, right? All the players in the middle are to a certain extent passing on price. So it's the farmer at the start who prefers to have a high absolute price for his cocoa, and the consumer tends to buy a low price. You see there also the retailer. So if the price for the chocolate bar is too high, the consumer may go to a different retailer. So the retailer wants to keep his customers, obviously. Therefore, the retailer will also push for a relatively low price to the confectioner who's actually making the chocolate. So that's something to keep in mind for the rest of this presentation. Now, the importance of price risk management is that it is very volatile, right? All ingredients for consumer goods are volatile, and cocoa is no different, right? So there is significant price risk in your activity if you're in the chocolate sector, and managing costs and managing price risk will improve your profitability wherever you are in the value chain. Now, one of the key instruments that you have in that value chain is hedging. Now, hedging is an investment that you make in order to reduce the risk of price volatility. You can a hedge actually is performed by taking an offsetting position in a related commodity. Now, that sounds kind of difficult, but I'll explain that a bit better. The ideal hedge for a cocoa beans purchase would be a forward sale of those same beans at the same time. So if I were to buy cocoa beans now, and also today I can sell these beans for a forward date at today's price plus all the cost, then I have an ideal hedge, right? There's no price difference from the price I buy and the price I sell. I just add my own cost and my own margin to that sale. That's an ideal hedge. However, ideal hedges are not always the case, because the timing of my purchasing and the timing of my sales may not be the same, and the price may have moved a lot in the meantime. So for a processor like myself, a forward sale of cocoa products in the same bean equivalents would also be a decent hedge. If I buy beans today, and I can also today find a customer that is willing to take my products at the bean price plus the conversion cost plus any margin that I would like to have, then also I have a pretty close hedge, right? So I have a good hedge. Now, however, you cannot always buy and sell at the same time while the price is the same thing. That's why there is a futures market, right? Now, a futures contract is a financial product where a buyer and seller of that future exchange a certain quantity of a commodity, so in our case that's cocoa, at an agreed price on a future date. So it's a very standard contract where a buyer and seller agree upon a price for cocoa for a future date. Now, there's a bit more to it. These contracts are standardized, right? So the seller and buyer agree on the price, quantity, the month of delivery, which is standard in the futures contract, and also the conditions and the quality framework are standardized. That doesn't mean that the quality is and the location are already clear, because there may be a final quality later on and the location is unknown. However, the quality framework is clear. So if the quality is different than that framework, then a premium or discount may apply. So how do we now hedge? In cocoa, there are two futures markets where cash cocoa beans can be hedged. So cash refers to typically to the physical cocoa beans, whereas the future can also be described as a paper, as paper trading. So in case of physical cocoa, these can be hedged at ICE London and ICE New York. Now, as the cocoa supply tops 5 million metric tons annually, and each player in the value chain that I showed earlier may want to hedge his price risk in the futures market, a tremendous amount of futures can typically trade on a specific day. All the various players in the value chain can manage their price risk in these terminal markets to a certain extent. Now, liquor, butter, and powder, so the cocoa products, can also be hedged on the terminal market. Typically, what you do is you hedge them in bean equivalents. So liquor, butter, and powder can all be recalculated back to bean equivalents and can then be hedged. However, what I earlier said, that you can hedge in a related commodity, cocoa beans, which trade on the futures market, are obviously related to liquor, butter, and powder, but do not have full price correlation with the products. So from that perspective, a hedge in the cocoa futures market when you are trading cocoa products may be less strong due to that lower price correlation. Now let's go back into the various actors in the value chain. Just trying to see if I'm in time. So the various players in the value chain. Now you can see here what I earlier explained, that the farmer typically prefers to have a high price. A farmer could typically pre-hedge. So what a farmer can do, he can sell the future at a level that he thinks is attractive for him for his eventual production. Now, in what I mentioned earlier, the retailer and the confectioner and the consumer typically tend to have prefer a low price for their products. The confectioner can decide to buy futures already when he thinks the price is attractive, right? That way, with this pre-hedge, the farmer can secure an attractive price for his crop later on, and the confectioner can secure an attractive price for his ingredients into chocolate. Now, I'll briefly show this in an example. What you see here is the price movement of cocoa over time. Now, this is obviously an example, right? So this is not an actual price. However, you see that cocoa prices can be very volatile over time. So the farmer may think, okay, when the market is high, I can pre-hedge by selling a future in the market. Later, when his crop only comes at a certain time, but the future trades every day, so he can choose the time when he actually sells a future, and therefore guarantee his minimum price for his crop. At the same time, the confectioner can buy a future when the market is low and therefore pre-hedge the procurement of his cocoa ingredients. Now let's go to the various players in the middle of the value chain, who typically are passing on price. Yeah. So the middleman, the exporter, and the trade house, they are passing on goods, right? So they may add value, of course, during the time that they possess the cocoa, but they typically pass on price. Now, in order to explain how these players in the value chain can hedge their risk, I'll first explain the differential. As I mentioned earlier, trading cocoa on the futures market is not a perfect hedge, because the physical cocoa that you trade, the cocoa that you trade on the futures market, is standardized. It's a paper trade. Whereas the physical cocoa that you are trying to hedge is not the same as that standardized product. So the difference in price between the futures market and the physical cocoa is called differential. Now, that differential can change, right? It depends on the origin and the specific supply and demand for such an origin. If a certain origin only has a very small crop, but there is relatively high demand for it, then the differential compared to the futures market will be high. Same goes for quality, right? If you have a physical supply of cocoa that is of very good quality and perhaps better than the standardized contract in the futures market, you will also have that will also have a positive impact on the differential. So the differential is typically something that cannot easily be hedged, but at least these players in the value chain can hedge their physical cocoa flow by trading in futures. Let me first give an example of an improper way of hedging. So suppose that you are a bean trader and you buy cocoa at a certain point in time, and the price is set at, that's when the crop comes to the market, and you buy at 2,800. Then you own the cocoa for some time and you sell at 1,600 because the market at that point in time may be low. So you have a significant loss. So what these players can do is that they can hedge their physical cocoa buying in the futures market. It's pretty straightforward. The futures contract is typically of 10 tons, is a contract for 10 tons of cocoa. So for every 10 ton of beans, you can hedge by selling one future. So when you're buying cocoa, you can sell a future, and vice versa. When you're selling cocoa, you can buy a future in order to manage your price risk. Let me give the example once again, right? We have similar price volatility. The buyer of the physical cocoa buys the cocoa at 2,800. At the same time, he's able to sell a future at 2,750. The difference between 2,800 and 2,750 being the differential. By the time he sells cocoa, he sells again at 1,600. However, the futures market has also gone down, so he buys at 1,530. In the end, since the differential in his contract went from $50 or pounds in this case to $70, he had a pretty good hedge and he benefited by $20 due to the increase of the differential. But his price risk on the futures market was entirely hedged. So this is a proper hedge. So all the players in the middle of the value chain who are passing on price while they have ownership of the cocoa, can hedge their price risk by trading in the futures market. Now, in order to be complete, I'll give a very short example how to hedge products, which is relatively straightforward as well, especially for liquor. Now, typically a processor would buy beans and sell liquor. So in this particular case, by buying the beans and hedging it with a future sale, and then selling liquor later and buying back futures. Now, the only thing is that when you convert beans to liquor, you typically have a yield loss. So the liquor yield from beans is roughly 80%. The remaining 20%, which consists of moisture and shell, is typically lost in the process. So the processor can, in this case, when he produces 80 tons of liquor out of 100 tons of beans, he can use that same yield in order to hedge in futures by using a hedge ratio of 1.25. So by selling liquor and using a hedge ratio of 1.25, this processor can still hedge his cocoa risk from buying 100 metric ton of beans. 100 metric ton of beans resulting in 80 tons of liquor multiplied by the factor of 1.25, which is again 100 tons in futures. So that way, the processor can hedge the price risk from his beans into liquor. Now, when it comes to butter and powder, it's slightly more complex because in the end, you produce two products rather than one. Now, in the example here, when liquor is being pressed into butter and powder, I used here that butter and powder come out in equal proportions. That depends a bit on the bean type, of course, but as an example, this is a pretty standard yield. So then the processor has two options. He can either consider both products at a ratio of 1.25 as well, because there's no further yield loss from liquor into butter and powder. So in case the processor sells its butter, it can use a ratio of 1.25. And if it sells its powder, it can also use a ratio of 1.25. And therefore, he is still perfectly hedged in a bean equivalence process. The alternative is that the processor hedges butter as 1 ton of products to 2.5 tons of beans and treat powder as a residual product. And then I mean residual from a hedging price risk management point of view. Now, the reason to do that is that butter typically has a much higher correlation to the futures market. So if you look at historical bean prices for butter, powder, and the futures market, butter has a higher price correlation and therefore can more easily be hedged in the futures market, whereas powder is has a more segregated price setting, I would say. So this is a very brief overview of price risk management in cocoa for the entire sector. So for all players in the sector, typically, as I said at the start, price risk management is a critical part of your business while you're in the cocoa sector, and hedging is a great way to mitigate that price risk. Now, speculation in the cocoa market happens a lot as well, but it's better done elsewhere. Now, thank you again for your time. At Cargill, we have a very extensive group of people that typically look at price risk management all the time, and we typically also help our suppliers and our customers in their price risk. If you would like to know more, then please contact us.
Thank you very much. Yep, thank you very much indeed. This is Paul. Thanks a lot for that. Look, there's a couple of questions that have come up on the Q&A. So if I can grab you while you're still hot, couple of questions. I can't tell you who they've come from because I'm not going to flip the screen, but two things. One was, what are you using at the moment for your hedge ratio on products currently? If you're able to answer that. And the second question is, could you define, somebody's asked the question of a tail hedge. Now, it said, whoever's written that has said tail end hedge. I'm assuming they mean a tail hedge. If you wouldn't mind answering, that'd be really helpful. And then we'll move on to Jason. That's okay, Job.
Yeah.
Thank you.
Now, so the product ratios that we use typically depend on the bean type. So we can have various recipes for our products. Typically, when beans have a very high fat content, they tend to produce more butter and therefore less powder. Also, certain beans may have a slightly lower moisture content and either a thinner shell or a thicker shell. So that also determines the actual hedge. Now, in our overall book, we tend to look at ivory cost as one of the main components. So the ivory ratio is typically what we use as a hedge. I cannot share the exact numbers that we use at the moment, but also ivory coast beans. Yeah, ivory coast beans also tend to change from one season to the next, right? So it's not the same every year. Now you can argue that also if you use both main crop and mid crop beans are much smaller. Therefore, the relative shell content is much higher, so they typically tend to have a lower ratio.
Perfect.
Now, on your second question, with regards to tail risk, can that be specified a bit further? Because I didn't really understand the question.
Well, if we could come to an end on that, I mean, if you want, and I'll clarify with whoever's written that question. They've said tail end hedge. Now, tail hedging is a quite a sophisticated. I think you'll agree, Job. If we're going to get into that, it's not really. I think we're probably best tackling that with the panel at a later stage. So, look, I think
yes,
given time, we'd like to pass on to Jason and thank you, Job. Thank you very much indeed. Really appreciate.
All right,
great stuff. So Jason, over to you. If you just in general, if you have any questions, please use the Q&A button at the bottom and of the screen, and we'll pick it up for the panel. So Jason, over to you. Thank you.
Well, greetings to all from wherever you may be in the world. Can expand on what Job currently discussed and go on to other hedging instruments that can be used. Going to start off here with options. An option is a contract that gives the buyer the right, but not the obligation to buy or sell the underlying cocoa futures contract at a predetermined price on or before a given date in sometime in the future. Okay. There are two types of options. There are call options, which is an option to buy, and a put option, which is an option to sell. And just so we have some vocabulary so that you're familiar with some of the terminology we're going to use going forward. Premium is the cost of the option or the price which one pays for an option. Strike price or exercise price, as some call it, is the price at which you can buy futures when purchasing a call or sell futures when purchasing a put. And the expiration date is the date when an option expires. Okay. When purchasing options, these kind of work like an insurance policy. Sellers of cocoa beans can protect themselves from falling prices by buying puts, which are the options to sell, and buyers of cocoa beans can protect themselves from rising prices by buying calls. Insurance is usually used to protect yourself from an adverse event. For example, if you buy life insurance, you pay a premium every month or every year, and the adverse event would be you dying, and then there would be some sort of payout for that. Just like any other sort of insurance product, like home insurance, car insurance, or things like that. So, okay. I'd like to give you a brief example here from a producer point of view, how an option hedge would work. Okay. Let's assume it's April and cocoa prices for July delivery are at $2,650 a ton. This is versus New York. A cocoa farmer expects to harvest 100 tons of cocoa beans between May and June. A farmer thinks prices will move higher between now and June, but would like some sort of price protection in case he is wrong. So the cocoa producer purchases 10 July cocoa 2,500 puts, which expire on June 3rd at $60 a ton. So his total investment was $6,000. Okay. Here is a graph of the recent charge for July cocoa. As you can see, this is as of Friday's close, I believe, we're at 26.52. July 2,500 puts were traded for $60. So the producer would have a break even here, which is the sell price of the option of 2,500 minus the premium paid of $60 would give him a break even of $2,440 a ton. That would be his sales floor, his price floor. If the market were to go up after the farmer buys the option, then the farmer would lose the $60, but he would end up selling his cocoa at a much higher level than it was when he decided to buy the option. On the other hand, if the market falls, the cocoa farmer can then exercise his option and set a fixation price of $2,500 a ton minus the $60 that he invested in the option. He would have a net sale price of $2,440 per ton. Now, on the other side of the equation, you have companies like processors that need to purchase cocoa, and they would be ones that would probably better off be hedging with calls. One example here is assume we're in April, as we are now, and cocoa prices for July delivery are $26.50 a ton. A chocolate maker needs to purchase 100 tons of cocoa in June. The chocolate maker thinks prices will move higher between now and June and would like some price protection. The chocolate maker purchases 10 July cocoa 2750 calls for $80 per ton. Okay. Similar scenario, we have a price ceiling in this case instead of a price floor for the cocoa processor. The break even for the cocoa processor, given that he purchases $80, is $2,830 a ton, which would be the strike price of the option plus the premium paid for it. Okay. If the market moves lower, the processor loses the $80, but he's able to buy cocoa at a much cheaper price. And if the market moves higher, then he can obviously exercise his option, and he has a purchase price of $27.50 plus the $80 which he invested in the option. Now, the complaint of many hedgers in the past that use options is that they're very expensive. And really, in my opinion, purchasing options should probably only be used for either a processor or a producer. People in the middle of the value chain whose margins aren't as large would probably be better off using futures or a different instrument or different strategies using options where the premium is reduced. So we can achieve this by maybe selling options. A seller of an option receives a premium paid by the buyer. Buyer of option, as I said before, acquires a right, and a seller of an option assumes an obligation. Okay. Options can be sold outright on their own, not without in conjunction with anything else, as a partial hedge. Options can also be sold as part of a strategy involving other options or futures contracts. For example, if in previous case where we bought a put, we could sell a put further out in price to reduce the cost, but we would only have a limited hedge. Okay, and quick vocabulary session here, spread. Spread is a simultaneous purchase of one option and the sale of another. For example, we can buy options with different strike prices. We can buy options with different expiration dates, buy and sell, and create different different strategies with different risk profiles and different potential outcomes. And these are just some of the potential strategies that we can use with options. Covered calls and puts, where you could be fixed with a futures contract and sell a call or a put against it to enhance your profit margin, but then it will give you either a ceiling or a floor to where you could potentially be hedged. There are collars as well, bull call spreads, bear put spreads, fence or risk reversals, calendar spreads, or they're also called time spreads or horizontal spreads, diagonal spreads, and ratio spreads. Okay. Obviously, for the length of time, we can't go into each strategy, but they are all available to anyone that would open a futures and over-the-counter account. Then as we get into more advanced strategies for options, we come across what is known in the industry as over-the-counter OTC products. These include lookalikes. Lookalikes would be basically the same products that you can buy or sell within a futures account, futures and options, but you're just doing it in the OTC space. Okay. The advantage of using OTC products is that you can use a custom expiration versus a standardized expiration that is used in the futures accounts. And you can also do fractional lots. For example, many times when people hedge, this will come with ratios as well. For example, if you would ship one container of cocoa, which has 25 tons, and the futures contract has 20 tons, or sorry, 10 tons, then the question for many hedges is, should I fix with 2 contracts or 3 contracts, which would either represent 20 tons or 30 tons. The advantage in an OTC product is that you could actually hedge 25 tons or 2.5 contracts, which is something you can't do in a normal futures account. You can, on the expirations, you could have them expire every day or every week, depending on your given needs. There are binary and digital options, Asian swaption options, barrier options, which are also known as knockouts or knock-ins, and quanto or compo options, which involve having currency risk that is involved sometimes embedded into the option strategy that you're trading. Okay. And then what many of the OTC brokers do is that they combine everything we see, futures, options, and all the exotic options that we saw in the previous slide, and they create something called a structure or an accumulator. This is a basket of all those products that when put together, they create either enhanced sales for sellers of cocoa beans or enhanced purchases for buyers of cocoa beans. Structures allow for sellers of cocoa to fix their sale price above current market levels. For example, if July cocoa is trading at 26.50, many OTC brokerage firms can design a structure and so that they can receive sale fixations in their account at 27.50, $100 above market. Conversely, if you're a purchaser of cocoa beans, you can structure products so that they can fix below current market levels. Same example, if the market's at 26.50, we could probably design something that can create purchases below at 25.50, 2,500, depending on the level of risk associated with that current structure. There are also, in addition to swaps being the result of these option strategies, structures, you can also have a cash structure, which instead of a futures coming out as a product, the structure will pay out cash within the hedger's account if certain parameters are met. And then just in summary, I'd like to go over a little bit what the overall benefits of risk management are. Obviously, it's a way for everybody in the value chain to protect their margins from adverse movements in the cocoa futures markets. You're able to better predict costs for future commodity inputs, which makes forecasting into the future much more reliable. In many cases, you have access to an order desk 24 hours a day during the week. Sometimes if you're price fixing into your client's account and supplier's accounts, you may be limited as to when you can place the orders for fixations. Also, you're able to use financial instruments such as options and OTC products. If you're fixing in a counterparty's accounts, many times you're not allowed to use these type of products. And then you're basically stuck either making a decision, should I buy or should I sell? When using option and OTC products, you can protect yourself by putting a floor or cap in pricing and decide whether the person buy or sell later on. Cocoa exporters at origin, many times they will ship their cocoa without fixing the price because they're speculating. They purchase cocoa beans and they expect the market to move higher and hope to fix it at a little higher price. So many times they will ship without a price fixation. Normally when this is done, the purchaser of the cocoa beans will pay him 80% of the contract versus the current futures price. If a cocoa exporter were to have their own futures account, then they could, instead of receiving 80%, they could receive 100% payment simply by receiving the fixation from the counterparty. Okay. Another issue that cocoa exporters have at origin when they don't have a hedging account is that they normally do not go out and purchase cocoa unless they have a sales contract, which is not advantageous because there's usually always cocoa on the market available for purchase. So by having, and the reason they do this is because they have nowhere to fix the cocoa, there's nowhere to hedge. But if they have their own futures account, they would be able to go out, purchase cocoa, fix the price in the terminal market, and then later on negotiate the best differential possible. Also, when cocoa players in the cocoa supply chain have their own hedging account and they're placing hedges in their own account, they present less of a counterparty default risk than those that do not. I've heard many cases of exporters who will maybe possibly fix in a counterparty's account. They don't have the beans yet. The market moves higher, and then they don't want to deliver because they don't want to buy beans at a higher price and then have to sell it at a lower price. Conversely, I've also heard players on the other side of the chain that don't have hedging accounts where they will go and they'll fix a purchase price with the supplier, and if the market moves lower, then they no longer want to honor that purchase price which they fixed because they know that they can buy beans in the current market at a cheaper level. If these players in the supply chain would have their own futures account and place their hedges within their own futures account, then they wouldn't be able to create this default risk for their counterparty. Okay. But also, if you have a futures account and be able to acquire more clients and suppliers by offering them an additional service of allowing them to hedge in your accounts. And also, for those that are concerned about margin calls, for certain clients, for qualified clients, margin financing is available. And that is all for now, and thank you for your time.
Jason, thank you very much indeed. Look, if it's okay, I think we'll open up to the panel as well. But before we sort of let you go, a couple of questions have come up through the Q&A, which I wouldn't mind at least steering towards you, if that's okay.
Sure.
Look, a couple of things. First thing, the question's been asked as to how a smallholder would be able to implement a strategy. Now, I'm assuming that the question is based on a smallholder that is unsold, obviously, because a smallholder that's sold their crop doesn't need to take risk management other than a risk management tool potentially for a risk that they were unable to deliver or they were unsure of their counterparty. So assuming that you've got a long, and how would you suggest that they look at managing that risk, assuming that they're long?
And we're talking about producers here.
Yes.
So they're obviously strapped for cash, and hedging with futures would be very difficult for them, meeting margin calls and things like that. And also by smallholder, I don't know what size we'd actually be talking about here. I think the farms here in Ecuador are a little bit larger than. Let's talk in terms of principle rather than practicality, just for a minute. What sort of strategy would you be advising? Let's say if
if let's say there was access through either a counterparty or for whatever reason? What would you suggest? How would you address that?
Psychologically, producers always think the market is going higher. It's a common joke that we say that the producer always thinks that tomorrow the market will be higher. And I think the best strategy for producers is to use options or price floors, which create a price floor for them, so that allow them to speculate them a little market, but at the same time create some downside protection for them. If they don't have the 10 tons, probably the best thing for them, or 10 tons that they produce, probably the best thing for them is a lot of smaller farmers are members of cooperatives. And if the cooperative could open a hedge account and then the producer hedge within the cooperative's account, that would probably be beneficial for everybody.
Okay, that's very helpful. Jason, if it's okay with you, just to say thank on behalf of everyone, thank you very much. Really excellent presentation. I hope there's been a lot of questions coming up. I hope the panel and guests will forgive me for putting my fingers on, because that's the only way I can actually see them. But look, I think a few questions will come up. If it's all right with you, Jason, that we'll open up and we can introduce the two other members of the panel, if that's okay. So Pam Thornton and Antoine Delsart, are you both with us?
Yes.
Yes, we are.
Great. Okay, well, look, if it's all right, I'm just going to throw some questions at you. And I think one that's come up, excuse my finger if that's what you're seeing, but there's a lot of interesting questions that have come up. But one is, what effects of the recently introduced living income differential in Ghana and Cote d'Ivoire do you see on the world market price, given the importance on the world of the two countries? So I suppose it is very much a risk management question, particularly for dealers and traders and receivers. And I think the question is a pretty big one, actually. So Pam, can I start with you?
Yeah, I did a little bit of research some time ago on looking at the lid. And I think one of the problems we encounter when we think of the size, particularly of Ghana and Ivory Coast, as the person who asked the question, 60% of world production, is we don't understand how big the global market for cocoa futures and options are, and how, in a relative sense, the size of the global crop and its impact on pricing is not as big as one might imagine. And if we go back to like 2005, the amount of futures traded, futures and options, I only could get data actually on New York, was about 8 times the volume of physical. So if the global crop at the time was, let's say 3.5 million tons, at the time we were trading about 8 times that in terms of futures. By 2019, we were up to almost 50 times. So all the value of all the physicals sold in the world were only equivalent to about 2% of the total pricing that went on in the market. And although that's dropped a bit with COVID, there is a misconception that the two origins can control pricing, because in the big picture, what impacts pricing, there's lots of speculation, there's currency trading involved, there's country activity, countries that need to get foreign exchange and so on. The power is far less than you would consider from just taking that 60% number. And of course, it's true that in the long term, if crops are bad, there will be an impact on price, but the timing of those moves and the magnitude of them are quite different. I'd like to say that I remember back in 2015, late 2015, when the crops, we started to have very bad harmattan in Ivory Coast and Ghana, and we thought the prices would boom. That happened to coincide with let's say a despeculation move, and we actually had prices collapse over the next 6 months. They went from I think around $3,400 in New York. A year later, they were down to $2,200, and they then went below $2,000. So you can at origin think you've got a lot more control over the world price than you actually have. And do I think the lid, I think the way the lid was executed perhaps failed to understand that all the middlemen that YOP has identified in the process are actually making relatively small amounts of money. And when you have a lid of $400 on top of a differential of $150 or something of that nature, there was no way for those intermediaries to really cover the risk on $500 or $550 of risk when they might only be making $20, $30, $40. So the reason we had a bit of an impasse between buyers and sellers was really this failure to understand how the hedging actually operates. And I think, as Job has said, origins should really concentrate their attention on getting the best absolute price, because that is what they pass on to farmers, particularly in a country where you have fixed farmer prices set by the government. And equally, the industry want to buy, industry representing consumers want to buy when prices are cheap. So you need to encourage liquidity between those 2 points. And the lid actually was putting a lid on a high price, made it unpalatable to consumers. And then when the market collapsed, consumers were eager, but origins obviously didn't want to sell.
That's very interesting, Pam. Thanks. I mean, I think that that answers a lot of the question. I'd like to maybe draw a little bit more out on this. I think one of the, I'm just going to throw something in as a wearing a panel hat for a second. I think that one sometimes can lose sight of the fact that markets aren't perfect, and that we generally have, we very rarely have a balanced market. We're normally in a surplus or a deficit. The issue, I think, Job explained it extremely well around differentials. And I think it's important to understand that differentials are a risk management tool. They're not an instrument of value. They represent value because they represent where the underlying, let's say, origin or grade or even product is actually trading. But the point with it is that it can't stop a surplus or a deficit. And I think the risk with imposing a high differential and making it extremely difficult to hedge is that it almost guarantees that the high quality cocoa becomes the surplus. And unfortunately, that is what's happened. So it does add an element of risk. It's not necessarily something advisable. On that theme, if I may, Antoine, look, a couple of questions have come up. One, if we'd like to get your opinion on what you feel is the best, or how you would feel that the lid has affected the market, and how you feel going forward that this can be incorporated. Another question that's come also from the group is, what impact do we think that the current legislation that's being proposed or being discussed, both in Europe, all over, and actually, frankly, all over the world, is going to affect risk management? If I can leave that with you.
Sure, thank you, Paul. Well, I totally agree with what you just said on the lead and the value of the differential. What I just want to add maybe here is, what is a futures market exactly, and what's the purpose of a futures market? There is one very key tool of a futures market, which is the delivery. The fact that if you hold the position until the expiry, you're going to have to deliver the cocoa to the exchange market, or you're going to have to get delivery of this cocoa. So what we've seen in the last few years in Western Africa mainly is a clear rise of the differential in a way that, if you take the value of this differential, if you add the logistics cost on top of it to bring it to Europe, if you had the trading cost, if you compile that in a package, it doesn't make any sense to deliver this cocoa, this good quality cocoa, to the London terminal. So we've seen basically only a lower quality cocoa that can be bought at a discount, that made their way to the terminal in London. So today we have this kind of strange situation where we are hedging 60 or 70% of the world production on a market where the underlying basically is more composed of Nigeria, Cameroon, some pretty old-ish cargo that is not necessarily very clean. That is in a BDU format. So BDU is bulk delivery unit for those who don't know that. So that means it's a pile of 1 metric ton of cocoa. So it's basically not that easy to get kind of rid of this cocoa and to clean the stocks exchange of this cocoa. So it's not a perfect hedge these days, and definitely the value of the differential, the fact that this differential have risen, are impacting that. And one solution for that, well, we don't know. Maybe one of the solutions will be to change a little bit the ICE contracts specification to add a little bit more flexibility around there. We know that ICE has made a pretty interesting move last year with the introduction of the perpetual certificate, which means that after the second grading of your cocoa in London, you get a perpetual certificate. So that could make this cocoa, these certified stocks in London, a little bit more sexy and push the industry to take part of it and use it. So we are yet to see that. Now to come back on your second question, which was the impact on this new regulation, whether it is in Europe and in US as well. You know that in US, the CBP has started the kind of same regulation a few years ago already. In Europe, it's being discussed. We know that it's going to come out. So basically, we know that all the cocoa coming into Europe will have to comply with this due diligence requirements. So we will have to show, I would say, a legitimate due diligence made on the supply chain and prove that it is deforestation-free and child labor-free. What will be the impact on price risk management and futures markets? It's a pretty tough question. As of now, we are not yet sure. What is sure is that it's going to add a new kind of complication for the futures market to be meaningful. Because if you need to get this cocoa in Europe that complied with the regulation, then what is going to happen to the cocoa that is already in store, that is already certified for this and against the futures markets? We are not sure yet. I think ICE needs to work on that, and I'm sure that they already are working on that. And then for us as a trading house, well, we've already made a lot of efforts. We've already made a lot of investments on the supply chain. We will keep doing so. We will keep investing in the management of our supply chain, making sure that we do comply with this requirement and that it does not come at a big additional cost for the customer, basically.
Thanks, Antoine. There's a couple more questions coming. That's very interesting what you said. I think it's very difficult to answer specifically on the question that's been asked us about legislation because it's coming at us in various different ways. But I think what perhaps might be worth pondering from all of us, and certainly there has been discussions at the FCC, and Robin is putting some work into, is to how to standardize a methodology of checking cocoa provenance so that we've got a level playing field. I think one of the things that can get missed, and I think it's important, I think it's an excellent day that we're discussing about how we manage risk today, because sometimes it gets forgotten. It gets forgotten what a futures market is for, what options are for, and how they're managed. And I think what would be potentially worrying is if we find that our options and our futures start to become dislocated from the real market, either through legislation or through the imposition of, let's say, unrealistic differentials. It doesn't help price risk. And I think in the long run, I think price risk is helpful for all participants. That would be my view anyway. A couple of further questions have come up. Let me just quickly go through. There's one interesting one that's come up very recently. The question is, given the fact the market is always right, these days a lot of AUM has gone from discretionaries to the CTA and systems. So what impact do we think that will have on the connection of the underlying value versus the futures market? Is it an opportunity for commercial players or a threat? Now, that's going to be quite an interesting one, that one. One thing I would just say, though, before I hand that, I'll go to Pam and then to you, Antoine, and then I think we'll take the other two, is that actually, I think, honestly, since the beginning of 22, probably surprisingly, more money has gone back into discretionary. I think commodities have become quite sexy, as Antoine used the word. I always find that's a little bit difficult with cocoa, but you know, we all really believe that. But the truth is that I think a lot more money has come back in. Commodities generally are under the microscope right now, given the inflationary pressures for a lot of reasons. So look, can I ask you, Pam, what's your feeling on the increased activity of CTAs and systems?
I think it does offer opportunities for traders, because you do get more dislocation. I guess looking at the arbitrage, for example, the last 4 years, where typically London had a premium over New York, which was really based on the rules of the underlying contracts. West African cocoa tenders at par in Europe and against the London exchange, whereas New York African cocoa is $160 premium to the contract. But we've seen huge amounts of money come in that don't really, they take a bet on, you know, the overall level of inflation, the overall level of activity in commodities, and decide it's a good asset class to get into. Some of it is discretionary, and I would agree with you, Paul. I think if anything, the last 2 years, we've been seeing hedge funds more active again in commodities, partly because perhaps the risk in things like equities was rising, so money was coming out of equities and looking for a home. But overall, I think the commercials, and I would differentiate, I don't think the industry really benefits so much from the dislocation, but I do think traders should be able to take advantage of that. When a trend, so CTAs are typically trend following systems, when they push a market too far, either on the up or down side, that is a good opportunity for traders who really understand what's happening on the ground and understand the strength of demand for those guys to get involved. So I personally like it when CTAs are active.
Thanks, Pam. Let me ask you, Job, if I may. What's your view on the increased, let's say, I mean, the question is to say, I think it has actually skewed a little bit more to the discretion, which personally I welcome. That's because I prefer human beings sometimes to machines. And I think sometimes we get a lot of volatility with not really a lot of direction. And I think that's extremely helpful for hedgers, quite honestly. I think it's a big advantage, actually, that you've got a certain amount of volatility that gives the opportunity for both sellers and buyers to, you know, I think yesterday the range was almost $100. And the market actually ended up not doing very much. That's an extraordinary opportunity, I think, for hedgers. So that would be my contribution to that debate. Job, what's your view?
Yeah, thanks, Paul. Well, I agree to most of what was said. Right now, CTAs typically tend to add intraday volatility as well as overall volatility, which cannot really explain by, I would say, the fundamentals in cocoa, right? So typically, the price of a certain commodity is driven by supply and demand. That's pretty straightforward. With CTAs coming in, you have indeed more price distortion, I would say, which does create opportunities. Now, Pam's example of New York versus London is obviously one that is rather remarkable in itself. And typically, these things have occurred more often, right? So there's more often that you would argue, okay, there's no real fundamental story behind London trading much higher than New York, or vice versa. And over time, situations will resolve to fundamental. Then it is obviously proper risk management is making sure that you understand your exposure, right? And that you have scenarios that where you say, okay, the market is now distorted in a way, they can still get even more distorted, right? So price risk management is understanding your risks and then trying to benefit from these distortions in the end, right? Because risk provides potential losses, but also provides opportunities. I agree with you also, Paul, that in general, speculators entering the market driving liquidity, and liquidity is indeed critical for hedgers, right? I mean, because that way there's a constant trading of all the time, which enables the people that actually take part in the cocoa value chain to hedge their positions. Now, what Antoine has mentioned as well is that risk that the futures market is becoming perhaps a bit less of a hedging tool for the physical cocoa trade, right? Now, which would I agree is a bit the case, right? And that is what I mentioned earlier in my presentation. The best hedge is an offsetting position in a related commodity. And the more related, the better the hedge. So indeed, if you were to compare price correlation between physical cocoa beans, a bit dependent on the origin, with the price history of the futures market, you would see that correlation is becoming a bit less. And that can have to do with increased CTA activity. It can have to do with that fresh cocoa may not be representative by cocoa that is on the physical markets, but that just adds to the overall risk, which every player in the end has to deal with. I think in the end, for the futures markets, it's important for the futures market that they continue to play their role as a hedging tool for physical cocoa. So both exchanges will need to follow the various I would say things that are impacting the cocoa market, like increased legislation, or like I would say quality, lid, etc., that they continue to follow the physical cocoa market and potentially adjust their contracts in order to remain a proper hedging tool for the cocoa markets.
Very interesting, and I think very good point, Job. Look, again, we must all remember to, I think for the audience and for the people who are interested in this discussion, the key about our price risk management is that the hedging mechanism remains relevant. It's never going to be perfect. It can't be all things to all people, unfortunately. But as long as it is a mechanism for daily and the ability for almost all participants to price the market, then it is performing a great deal of its function, even if it may not be perfect. Markets always distort, and I think that's an extremely good point, Job, that you're making. That we never want it so far that it becomes dislocated. My take from what you were saying, and I think the advice that you're really giving is always remain vigilant. Use your intelligence, use your analysis, think about where the distortions are, because those risks and those anomalies and those distortions can be very advantageous for a trader. And I think that's very important to remember, that that is part of life, that we don't get a perfect hedge. Jason, can I get your thoughts, please, on your views on discretionary, the volatility perhaps that we've seen, and the participation of specs in the market? You there, Jason? If not, I'm going to go back to you, Antoine. If that's okay.
Yeah, no, I'm here. I'm sorry, I got a little bit.
Oh, sorry, Jason. Beg your pardon.
I've told many people, my opinion is that for the most part, fundamentals are not what drives the market. If you take a look at the weekly COT numbers, commitment of trader numbers, and you put it on a graph, the fund position versus the price of cocoa, there's a pretty good correlation there. And I think part of it is that cocoa is such a small market compared to other commodities. We have average trade volume in New York of 40,000, 50,000 lots, compared to something like corn, which you see over 1 million lots traded. That a medium to large size fund, if they want to get in and out of a position, can move the market by themselves. And yes, the added volatility creates opportunities for people in the middle, traders, physical traders. It creates, especially with all these option contracts and OTC structures, the added volatility enhances the products they can trade and market. But at origin, for example, it creates a problem. An exporter that may do 10,000, 15,000 tons might have a margin if they do things by the book, where they're purchasing cocoa and going back to back and fixing, may have a $20 to $30 margin, maybe $50 margin. And then how do you deal with that margin when you have a daily price swing of $100 and you have to provide the same price throughout the entire day? That's a bit of a problem for them. And I think there is some distortion. When market makes moves, a lot of it may be based on fundamentals or what future fundamentals are expected to be. But I feel that the moves are a bit exaggerated, maybe 30% of what they really should be. I remember with the case of, what was it, Ebola and back in 2014, 2015, the market was much higher than it was, simply because the news filtering was there's Ebola, but it never really affected Ghana or Ivory Coast, and it was artificially inflated because of the spec position. I think they were along like 80,000 lots, a record amount, or something like that. And as soon as that went away, the market basically corrected 50% of the price within a year and a half.
So great opportunity for origins there. So that's really an example of where spec participation has been excellent for producers. Now I'd like to just quickly ask you, Antoine, what are your views on the participation of the larger AUM, the spec community, discretionary, and so on? What's your take on that?
Well,
small market.
It's definitely a small market, and as you said, and as Oza said as well, and Job mentioned that very well, they are bringing liquidity, and they are bringing liquidity in a market that is small. Cocoa is a little bit more than 4.5 million tons a year of production. Of course, the trading volumes on the futures markets is much higher, but the fact that you have these guys in front of you is definitely helping you on a daily basis in your trades. You also have to keep in mind that 60% once again of the crop, mainly Ivory Coast and Ghana, are selling their crop a year to a year and a half forward. So when you're a trading house, you need to hedge a year or a year and a half forward, which can be a little bit difficult. So yeah, the fact that the specs are in, the fact that they are bringing liquidity is surely helping us. And on the other hand, they can sometimes push the market in a way that that is not necessarily following the fundamentals. So, I mean, at the end of the day, yes, cocoa market is usually coming back to what is cocoa and what is the cocoa fundamental situation, but still, there are some occasions where market is pushed up or down without any strong justification, without any strong feeling. Is just the fact that these guys have money to invest. Recently, we've seen that a lot, and they've been coming in a lot. We know that money was almost free. We also know that cocoa was relatively cheap compared to other commodities, especially in the last few months. So they probably took that as a pretty good investment. And for trading houses like us, when you are hedged on the forward, if you are long of cocoa, short the futures, this could impact you pretty bad on the margin costs, basically. So there are pros and cons. Liquidity is a fact. Daily trade is definitely a fact as well that we try to take advantage of. On the other hand, there are also sometimes creating issues and sometimes making your life a little bit difficult. But at the end of the day, we need them. That's for sure.
Okay, listen, we've had quite an interesting question, which is whether or not the futures market is still, something that we have to live with because there's nothing better, but that it's lost its relevance. I'm gonna share that with the panel, and then we have one last question, which it was inevitable it got asked, and I'm very, very pleased that it has. And I will quickly ask everybody on the panel their view, which will be at the end. So I'll give you a chance to think about it before we close the webinar in about five or 8 minutes. Which is, what do we think the high and low will be? So I think what we'll do is we'll say between now and the end of March next year, what we think the high and low will be. So just bear that in mind. Look, I'll add one comment as a panelist, which is that, look, cocoa's small, but it's perfectly formed. It's still the best market in the world. It's still the most interesting commodity. It's still one of the most extraordinary ingredients and brilliant markets in the world. It brings together an incredibly diverse number of people. It's grown in areas which most consumers wouldn't have heard of if they weren't chocolate addicts. It's an extraordinary market. It's extremely high value. It employs millions and millions of people globally. And I think one shouldn't forget that. I would also probably throw in just to your comment, Jason, that although I think that the market is a little weak, the point that's been made about Ebola is very interesting, because yes, it does trade wrongly, it does dislocate, but it always mean reverts. And I think that you can't get away from the fundamentals ultimately. Somebody eventually runs out of money. And I think that generally fundamentals do long-term drive the market, but it makes a lot of opportunities in between. So look, if I may, can I ask you, Pam, what is your thoughts? There's one last question here, which I thought of you. Do you believe that the futures market is becoming irrelevant?
No, not at all. I think we should just get away from the mindset. It's almost like, do we feel WhatsApp or Facebook or these other things are irrelevant because we lived without them years ago? The fact is that there is more interest in people trading. All sorts of people who've never traded before have been encouraged to trade by the rise of electronic trading and the ability to do things on their phones and that. And so it's a fact of life. If we want price transparency, we need to accommodate all participants. And for example, now with the Ukraine crisis, lots of people are taking a view that might lead to a global economic slowdown and therefore commodities should go down in price. Other people might think it's because of high energy costs and high fertilizer costs, prices of commodities should go up. So I feel we should be happy accommodating all people's opinions. And of course, it makes it harder for those of us in the kind of the nuts and bolts of physical trading to navigate these storms that might come at us. But to try and pretend we can kind of go back to a world where there is no futures market and we just do transactions between each other, I don't think that would be in anyone's interest. It's the liquidity. And in fact, futures and risk management also gives a tremendous amount of transparency to the players, both within companies and within countries. If you actually are able to trade futures in any shape and form, there's a clear paper trail behind it, which makes life so much easier for everyone. So no, I don't advocate going back. I think you should embrace it. And as we just described, when Ebola was a cause for concern and prices went high, as Paul mentioned, that was an ideal opportunity for origins to sell. And equally, you know, there are opportunities for industry when prices are cheap and they can extend cover for 3 years and know that they've got comfort in pricing their product to the consumer accordingly. So no, I don't think we can put our head in the sand.
Right, very interesting, Pam.
If I could just interject there, well done, Pam. Thank you for that. And Paul, if I could just say that you've got 2 minutes before I'd like to wrap up.
I'm aware. All right. So look, what I'm going to do, Job, just your quick last thoughts, and then finish, please, telling us what you think the high and low is going to be. Sorry, we have to do that. We're being asked to do that, Job. So you have no choice.
I have nothing much to add to Pam's story. I fully agree. I mean, I think the market. I'll start with London. I think it's slightly underpriced at the moment. I think if we were to go down a bit down from today's levels, then it makes tremendous sense for the industry to pick it up. And there's some upside from my perspective. So I would say £1650 is the absolute minimum, and I would say £1950 would be a maximum, perhaps 2,000 for London. Yeah, and New York, I think it's a bit overpriced compared to London at the moment. So so that range is slightly less, has slightly less upside. Let me put it that way.
All right, that's very interesting. Antoine, go on. We have to force your hand.
No problem. I think we are missing something new in cocoa right now. We are missing a new story. We are trading in a range for a while, and I think we're gonna probably still keep this range for the next few months. So my call will be not very far what Job just said. So 1650 in London up to probably 1900. And New York, yeah, the value of the arbitrage has never been so wide. But I do not see any strong reason for this to change in the near future. So just checking now, yeah, I would say probably 1500 up to 1700 for New York.
Okay, there we go. So I hope our group are happy. Pam, and then you, Jason. Pam, you there?
I'm right there with Job. I do think the Ukraine thing perhaps means economic downturn. So I would say London, 1700 to 1900, and New York probably 23 to 28.
Jason, and then we'll hand over to we'll hand back to Robin.
I have a feeling that the projected deficit is going to be smaller than what people are forecasting. I think we're probably going to go lower in cocoa, 2200 floor, and we've probably seen the high for the next 12 months, which is around 2027. And London, I really, it's not something I look at.
Great, thanks very much, everyone. I'm going to say I'm going to be a real pussycat and say 22. to 3,000. So huge range, and basically because I'm afraid of saying anything, quite honestly. Thank you very much indeed, everyone, panelists, and I hope all our guests enjoyed. And with that, thanks very much for the time, and we'll pass back to Robin.
Well, thank you. Let me just first of all say thank you to everyone for participating in this. And I'm sorry not all the questions were, it was possible to field all the questions that came in. So apologies for that. I'm sorry that the good news has ended, but let me just say or repeat rather, that the FCC has online modules and you can subscribe to them at any moment. Interestingly, we have a third module that's in progress at the moment, and that involves a video of a bean quality analysis. So we are looking to produce that as a module, and that hopefully will be with us in the summer. So we are continually adding to these modules, and please note that there is quite a lot of activity there. And secondly, we have our courses, Introduction to Cocoa and Cocoa Contracts and Arbitration. You may have seen, hopefully at the beginning of this webinar, some details. Please check our website and you'll find more information there. They're going to take place during June over 1 week, and they will be based here in the UK, and they will be face-to-face. There are limited spaces, so please get in touch with us as soon as possible if you wish to register on that. Our next webinar is likely to be before the new crop year, so that is basically before the end of September, beginning of October. I do hope that you'll all be able to join us. So once again, let me just say thank you to Job and Jason, and also to Pam and Antoine, and also to
Robin, if I could just say, if anyone wanted to email me, I'm happy to answer the questions directly. A lot of them were anonymous, so one can't do it, but I would. Okay. I'll take the tailheads, for example, if they want to get my email address and write to me.
Okay, well,
that's done, a great offer.
Thank you. Thank you. And I expect quite a few people will be taking you up on that. So let me just say finally, thanks to Paul for the time and for guiding us through a very interesting question and answer period. And a special thanks goes to all of you for joining us today. I hope you found it of interest, and we look forward to seeing your attendance in our future educational events. So without further ado, thank you and goodbye from the City of London.
Thanks, Robin.